What if I told you one simple investing decision 10 years ago could have dramatically changed your portfolio today? The Magnificent 7 versus the S&P 500. One concentrated bet. One diversified strategy. Let's see which actually won. First, who are the Magnificent 7? We're talking about Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, and Tesla. These companies are absolute titans, dominating their respective fields from cloud computing and AI to e-commerce and social media. Their growth over the past few years has been nothing short of spectacular. In 2023 alone, their collective performance was a huge reason the S&P 500 had such a strong year. In fact, without them, the index's returns would have looked a lot less impressive. So, the argument for investing in the Magnificent 7 is pretty straightforward. You're betting on the proven winners, the innovators leading the charge into the future. These companies have massive cash reserves, incredible brand loyalty, and are at the forefront of the AI revolution, which could fuel their growth for years to come. If you believe technology will continue to shape our world, then concentrating your investment in these leaders might seem like a no-brainer. You get concentrated exposure to what many consider the most powerful growth engines in the global economy. But hold on, it's not that simple. Let us talk about the S&P 500. This index represents 500 of the largest publicly traded companies in the U.S. It's the ultimate diversification tool. When you invest in an S&P 500 index fund, you're not just buying a piece of big tech. You're also getting exposure to healthcare, finance, consumer goods, energy, and so much more. This is the classic don't put all your eggs in one basket strategy. The biggest risk with the Magnificent 7 is concentration. Their stocks have become so large that they now make up a historically high percentage of the S&P 500's total market cap, nearly 30%. This means that if just one or two of these giants stumble, it can have an outsized negative impact, not just on a Mag 7 portfolio, but on the entire market. We saw a glimpse of this when tech stocks corrected in the past. High valuations also mean high expectations. If one of these companies misses an earnings target, the punishment can be swift and severe. So, what's the verdict? The Magnificent 7 approach is a high-risk, high-reward strategy. It's a concentrated bet on continued tech dominance. If you have a high-risk tolerance and a long-term horizon, it could potentially deliver stellar returns. However, it also exposes you to significant volatility and concentration risk. On the other hand, the S&P 500 offers a smoother, more diversified ride. It's the bedrock of many long-term investment portfolios for a reason. You still get a healthy dose of the Magnificent 7. But their performance is balanced by 493 other companies across the entire economy. This diversification can help protect your portfolio during downturns in specific sectors. For most investors, especially those who are just starting out or prefer a less stressful journey, the S&P 500 is often the more prudent choice. Ultimately, the best strategy depends on your personal financial goals, risk tolerance, and time horizon. Some investors might even choose a hybrid approach, holding a core S&P 500 position and then slightly overweighting a few of their favorite Magnificent 7 stocks. There's no single right answer for everyone. The key is to understand the trade-offs between concentration and diversification. What's your take? Are you Team Magnificent 7 or Team S&P 500? Let me know your thoughts in the comments below. I'd love to hear how you're approaching this in your own portfolio. Thanks so much for watching, and if you found this helpful, don't forget to like this video and subscribe for more content. See you in the next one.